Minutes here before we kick things off. Market obviously is tanking big time. It's like a celebration to the downside for everybody that's been bearish for like 5 or 10 years. So everybody's happy if they've been bearish. So we're going to go ahead and check things out right here on the technicals. I'm going to give you some technical breakdowns as we go in, and I'll give you some thoughts on the option trading as well. So that's what we're going to kind of go into right now. Keep in mind, none of these are recommendations. I can't recommend you anything because the market's very volatile. I don't know you personally. I might not even know what I'm doing. I just, you got to take this all with your own grain of salt and insight because everybody trades differently. Your account might be $5,000. Your account might be 50 million. I don't know your situation. I don't know your length of duration. If you're 10 years old and you're looking to invest for the next 80 years, or if you're 80 years old looking to invest for the next 5 years. So everybody's different. So in either case, make your own judgment calls. But I'll give you my own personal take, and I'll try to be as detailed as possible as usual. So feel free to reach out and ask some questions. We're going to go in and chat about a few different things. I'll also show you kind of my paper portfolio, which I haven't kept track of the last couple of days, only because I had to manage my own positions because they were moving so quick. The market's very fast these days. And with a fast market, I have to do the live account much more seriously and be a little more focused on it than I can be on the paper portfolio. Oftentimes I'll do a lot of the paper portfolio here and set up some basic trades for a lot of the coaching and mentoring and one-on-one sessions that I do. And that way I always have some sample trades going on and showing you what's making money, what's not. But this last few days, over the last three days, I haven't been able to do that as much. So anyway, one of the big things I will show you is that it's always nice to not have everything bullish and not have everything bearish. You can see I've got some hedges on in place here, which are helping me out a bit. I probably should have done a little bit more of that. Some of the other trades that I have are just toast. They are done and they are dead. And that's when you're kind of like thankful, hey, I'm thankful that I'm in a risk-defined spread in some of the positions. But stuff like this speculative TKNG, this thing is dead. Right? And that's why you don't put a lot of money into stuff like speculative as well. And when you're buying things like long portfolio, you're always spreading your risk out. You don't get everything on, like, say, March 1st, or February 10th or January 24th. You don't buy all of your shares all at once or all your positions. You concentrate and spread the risk. It's about spreading risk, spreading capital. You throw a few things over here. You throw a few things on this day, here. That way, if you got a shotgun or something happens, boom, this blows up. All these other ones might be okay. Or even if, you get a lot of problems, at least a few are okay. So that's kind of what I did with some of these hedges, and these are for the downside. Obviously, I got negative delta, and they're doing fine. They're doing well, right? But comparing to like a lot of the other portfolio I have a huge concentration of like long portfolio, like most people, and with a lot of people that have long side, upside portfolio, you're going to take a beating on things like this. But this is where you start looking at, look, if I was interested in buying Apple for the long haul, and I was okay with it at higher prices, wouldn't I be okay with it now at lower prices? So anyway, so that's kind of my thought and take. So, all right, let's take a look at some of these things here. We got some questions coming in. So feel free to ask your questions. I'll give you my take on some things here in the marketplace. I'll just give you a big pinpoint. News, all that stuff, it really is irrelevant. In the end, remember, price happens first, then comes the news. So it's always price dictates the news reports on the price of what's going on and happening. So price is always more dominant. Okay, so hey, how you doing? Mercy, how you doing? Ama. All right, so we got a question. Sasha, what do you have to say about mRNA and Affirm? So Moderna, I think is, it was hyped up quite a bit, and now it's pulling back, and I think it'll probably continue pulling back for a while. When you look at this chart, I think you got some really good support at a little bit lower levels. But I think, you've broken some critical levels here. Hopefully my mouse is not dead. Oh boy. Hope my mouse isn't dead here. I'll give you 1 second. I think I just killed my mouse. Because now I can't see anything that I'm doing. Let's see, task manager, and then let me kill Bad time for it to happen, huh? Because I use a drawing tool and program, and sometimes it just... I can see it on the other screen, but I can't. Okay. I can see it on one screen, but I can't see it on my regular screen. So let me try, give me 1 second. I'm going to try to kill it. Yeah, you know, going live, and then all of a sudden the drawing program took over the app. I hit the wrong control key, and I'm going to see if I can kill this, kill that drawing program real quick, and then start it back up. But I have to use my tab keys to get over there. I can't even kill it. Let's see, where is it? Wow, can't even see it. That's not good. Let's see. Sorry about that. Or I'll have to look off the other screen to make it happen. It's not working. All right, maybe I'll have to, let's see if I can do it this way. Okay, I'm gonna have to look off my other screen to actually make it work. All right, so Moderna, when I look at it, this stock has not been doing very well. Can you see my mouse actually as I'm using it? Because I can't see it. But Moderna, I think it's more extended, or very extended for where it is. You're going to look at probably some support levels around like this $86 price level, and 57. So I think that pullback is very serious for the time being. But a 50% pullback is possible, right? So if you look at this pullback right here, and you go up to about 482, half of that, you should be down to about 82 on the chart. So I think once we get down to a little bit lower levels, you could get a bounce, and this stock could hold its own. But for now, I mean, we've got some huge selling pressure. And I think for the short term as well, we've had okay movement right here on the downside, which means you'll probably see a good snap up soon. It's just be careful when you see the snap up. You could get that rejection again for, probably a lot of bounces. Just like here, a lot of the bounces will probably be faded in this type of market condition. So be a bit more careful here. It doesn't matter which stock you're trading. It's just be a little more careful. As you start seeing like this move, you see a big breakdown here. And your trend now is starting to kind of go this way. And that's becoming a little bit more of the issue, is that now anytime you get this bounce and rejection, you're getting bounces, but you might see the rejection. So the trend is now pulling back quite a bit. Okay, so that's a big thing to watch with something like Moderna. A firm here, I don't know if you're talking about this one, Affirm Holdings. I mean, this stock is, in my opinion, you're way down at lower levels right now. So again, it's just anybody's guess. With a lot of these stocks is like you could try and buy the dip at this level, but what you want to do on stuff like this is like, if you're looking at it, you got to think about it like this. Am I a long-term holder? And long to use different? Is it a 6-month thing, a 1-year thing, or a 10-year thing? Like, where does this fit in? Where does this thing, this 3 to 4 letter ticker symbol, where does it fit in for you? And for everybody that's different. That's why it's tough to make like recommendation videos or anything like that a lot of other people will pump up. In my case, it's like, look at what is this? What does it fit? Is it long-term? Is it short-term? That kind of thing. Is it medium-term? So here, if I'm looking at these support levels here, I could see a bounce here, but a lot of times these bounces will fade. You got a lot of gap, which means there's a lot of weakness in pricing like this. So you can pop here, and then you can get a sell-off, and that could be a huge problem. So you could get a pop, sell off, and it could trend here for sideways for many years to come. For now, the value here looks to be okay from a chart perspective. I don't know the company as much, and the selling pressure is easing off compared to some of the previous volume. But you do have some issues. Like this could be kind of like a double top. Even though it doesn't hit it perfectly, some people will say, oh, it's not perfect, it's not perfect. Yeah, they don't hit perfect. Look, if somebody tells you to show up for dinner, I always say, if they tell you show up to dinner at 7 o'clock, do you show up at 7 o'clock? You might show up 6:59. You might show up at 7:01. It's not exact, right? Same thing here. Not exact. It's not going to happen perfect. So here, if we look at it, yeah, we're looking at around between 50 and kind of 55 support. And you can see once you get oversold, you will get a snap up usually. And the same thing here at 91. Like if you like this stock, if you liked it at 100, right now it's like a steal, right? But for me, those kinds of things in this type of market, I'm looking at more stuff that's like a McDonald's or a Microsoft or those types of things. For the long investor, this is like great, buy, hold, that kind of stuff. But I would still do it in a smarter way, right? A smart way of doing it. So that kind of thing. That's the way I would approach it. All right. So, Nima. Okay. What is the reason they are giving for the market crash? There's no reason, Nima. It's so far half the Corona drop happened in early, talking about the SPX. Okay. So let me be clear about this. A lot of people look for reasons, like why, why are some people, why do they have a birthmark? Why do some people, run better than other people? It's like, yeah, some of that could be training. Some of that could be the right fitness. Some of that could be genetics, but it's never one specific reason. As a human, we are tied to our money and we're trying to figure out why. Like, what? We're curious, right? Curious George. Like I always read the book to my son there. There's a lot of stuff like, why? Why is this happening? It doesn't matter why. The only way to know why is if you look at the order flow, like look at this. How do I get it? Look, I get 138 million shares of order flow, and every ticker has to have a reason of why, and everybody has to fill it out. Like, why did you buy or sell this ticker today? And then you have to analyze that in a tabular data and say, okay, let's say 25 million shares were traded because one person was buying it for their grandchildren. Another 15 million were buying because of coronavirus. They were worried about coronavirus. There's no reason why. The news just tries to dictate why. But in other words, the market gets into a panic frenzy. More sellers than buyers. That's really the why. And the rest of it is just we try to make up stories in our mind, and these are the biases that happen cognitively, psychologically, and it doesn't even matter. There's a lot of YouTube channels out there that will always try to reason with you the whys, the fundamentals, but those things only apply for 6 months plus. The whys can only pan out for 6 months to a year because it takes a long time to turn a big boat around. That's the way you got to look at it, that's the why. So it doesn't matter, in other words. All right, Sonny. Hey, how you doing, Sonny? How you doing, Napoleon? All right, Apple, Microsoft, buy the dip for long-term 3 to 5 years. Yeah, you can. But again, the way I would approach it, so if you're looking at Microsoft, there it is. Still can't see my mouse cursor, but if we're looking at Microsoft, like take a look at this Microsoft right here. You've got earnings coming up and this thing had a major dip. Yeah, absolutely. You're coming into some nice critical points and levels right here in Microsoft for long term. These things are great, but I always look at it a month time frame. You're going to get fake outs. You'll probably get a pop somewhere into here and a rollover. Also, earnings have been very nasty, meaning doesn't even matter if the company reports good earnings. Usually what happens with earnings is if companies sell off, and the way the market is feeling, even if it's good earnings, those earnings, the market will still behave badly. And I've seen this from different people I've talked to that are actually insiders. And they told me, like later, like way later after the earnings have been released, that sometimes even they get privileged knowledge and information to their earnings, and they're going to be like explosive great earnings, but the stock will still sell off, and vice versa. Like it'll happen all the time. So my point is that watch out for earnings right now with Microsoft. But if you're trying to spread out your position, try to spread it out across, like, let's say a 60-day period. Don't just do it all in one day, because what if we continue rolling and we can get it at 230? So if you're looking at a longer term, just spread that stuff out, Sonny. That's the way I would look at it. Apple, in the same way. Look, you're coming in. It's nice. When you get a bigger dip like this, like let's say you normally are buying like 20 shares. And again, if you're doing it in options with 20 delta, that's fine. Vertical's fine. Same thing. But you're doing it like, okay, 20 shares. But in this case now, let's say you're doing 20 shares a month. In this month, you might say, I'm going to go 40. Why? Because you get a better value, a better pullback, right? In this month, you might have done 20 or only even 10. Okay. This month, again, maybe only 10. This month, maybe 20. This month, again, you're back to 10. This month, maybe 40. So you're trying to allocate a little bit more on huge pullbacks or better value opportunities. That's the way I would look at it from these types of positions. I hope that helps. Sonny. Okay, Javier, welcome, relax, investing for the long term. Yeah, all YouTubers need to chill. I'm getting so much notification like it's the end of the world. Yeah, exactly. Like, look, if you're looking at something like Apple, if you liked it like a few months back and you liked it at 180, wouldn't you really like it at 157? Yeah, exactly. But you want to trade accordingly, right? Because what people do is they over leverage. A lot of people trade too large. And if you feel nervous and super scared, you probably allocated too large of a position. That's usually the biggest sign and biggest issue I see when I deal with coaching and one-on-one sessions with people is that they often just have kind of too much capital on the line, or they put too much capital in one day, or that type of thing. So yeah, absolutely. There's a lot of YouTubers that have to chill. Like, I mean, Adrian, I'm not looking for the why, I'm looking for the how can I take advantage of this downtrend. Well, Adrian, if you're trying to look to take advantage of this downtrend, if you're a long-term investor, you're looking at buying the dip. That's just the natural tendency. Or you're waiting for the opportunity for when this market pops and then you short it. Because that's probably what a lot of people from the investment community will do from a trading standpoint. Again, depends if you're a longer term investor or shorter term. I don't know everybody's time horizon. But what you're doing is if it comes up and you start seeing weakness, you're shorting. Okay. If you're a long term investor, you're kind of buying on value. So you could be positioned at different points. Everybody's at a different, looking to invest in a little bit differently. So you have to kind of dictate that. What options should we be trading now during the time of the market crash? Okay, Mercy, it's going to depend, like what type of strategy you're trying to pull off. And oh man, I hope I can, I can't even see my mouse here. Okay, so from the options standpoint here, there's a handful of things you could do, but you have to look at the skew. And here's a little bit of the issue on this. I'm going to have to kill kind of some of this chat stuff because I got to be able to see my mouse on the other screen. If I look at the skew, and you can only look at it on the daily, and you have to change the style. I posted this on the Discord members the other day that the skew was very off. Okay, so when you look at the skew, it's starting to grind back up. But when you really look at stuff like an Apple, and just to show you, and we'll go to actually, let's go to who released earnings, JP Morgan. So let's go to like a 30-day option contract right here. Okay, and with the 30-day, what you're looking at, here's the funny thing. You've got this 140s, the puts and calls normally should be equal, but you've got this at the money at 760 and this one at 380. That means you're going to be paying up for one of these spreads much more than the other one. Okay, so if I look at JP Morgan here, and here I've got the 140, 145, I'm going to change my order type to blast all. See, I got to look here, and then we'll do this one over here by a vertical. Apologize. Okay, so now what you normally will see is this puts and calls, they should be equal or very close to equal. Stock is trading at 143. We're right in the middle pretty much. These should be very even. But the market is dictating actually the puts to be at more favorable or better value. So if you're actually trying to buy calls right now, you are paying up quite a lot on the spreads. Okay, so just understand you're paying up a lot more on the spreads on the call side because look at the calls. They're trading at 288. Okay, whereas when you look at the put side, they're trading at 218 for the same spread, and they are tied together, right? And here, when you look at it, you're paying up for it. That means you need that stock to move much more than you normally would on the call side. And that is because, yeah, we've been selling off for quite a while, and you might see a pop here very soon. And you're kind of already seeing that. We were down like 140 on the SPX, and now we're down only 66 or 70 points on the SPX. And, they're kind of budgeting for a pop, at least temporarily. And that's why you're seeing the price discrepancy. So, Mercy, if you're taking a look at which option should we be trading now, it's the question of are you trying to do a single individual positions, or are you trying to protect a certain capital? If you're just trying to trade some options, I think vertical spreads at the money is very good. Maybe 30 to 60 days, usually go longer duration because you want to spread your time risk a little bit more. If they're shorter duration, you'll have more pricing risk. If they're longer duration, you'll have less pricing risk. But if you do verticals, you also don't have vega risk or theta risk as much unless it's starting to move outside the range. Because if I go in, even with the call options, even if I overpay kind of, look at my theta and look at my vega. I almost have no vega and no theta, so I don't have to worry about the time value. I also don't have to worry about my my volatility. The only thing I'm looking for is a delta, and I'm looking for a pop. Yes, I'm overpaying a little, which I know I probably could be somewhere around 225, 218, you know, so the spreads are a little wider on the call side and a little less favorable. But even at that point, I try to get rid of the theta and vega if possible. So I'd probably do these types of spreads a little more. I'd also probably do like gamma iron condors, you know, like something like that, where you're actually buying. But the problem with that is also these are positive vega trades, so you need to be a little more careful, because when the vega does go down and the market pops, you do need a huge move outside of the expected move. Those are a little more, much more advanced though. Usually I do that in more mentoring kind of stuff. All right, Mikhail Ranjan, any way to reduce high delta with less capital? I am on the verge of a margin call in a portfolio margin. Yeah, it's tough. To reduce delta, we talked about this before. There is a way. You could do things like synthetics. They don't, maybe. It depends. Like normally you got to look at the accounts for that. But we've talked about this before, where you could kind of pause your position. And what I'll show you here, I've talked about it before, is it's a synthetic position. Sorry for the pop-ups, guys. They kind of just automatically pop up. Here, let's cut this and kill the chat there. So for these synthetics, like if you take a look at this synthetic, this is buying like a combo, which is a synthetic, and I'm long 100 shares, but it's a lot cheaper than getting the stock. And what I could do is actually the other way. Okay, and I can do the synthetic this way, and now I am short 100 shares of stocks. So it depends on which ones you're trading on. You can kind of use options, just buying a call and selling a put, or selling a call and buying a put. You can do them in this way to kind of cut your delta, depending on how much delta you need to cut. If you're trying to cut overall delta, doing it on the SPY is usually pretty good, or like QQQ, IWM. And then you can kind of work from there. But always make sure when you're doing something like this, to watch that you beta weight everything based on whatever you're kind of hedging. And in that case, I'm doing it based on the SPY here. So that's kind of how you could do it. You can also go in and sell deeper in the money. Like let's say we're doing JP Morgan. Instead of selling calls out here and making, excuse me, $37, why don't you go in and you can also do stuff at around $700. It's in the money, but that's if things continue to tank, right? The problem is now you're at the point where if things snap up, then you'll get the stock taken away. But that's only if you bought these things at a profit way earlier. If now you bought them way earlier and you're at a loss, the stock's going to be taken away, but at least it shortens up and reduces your delta by like 70% or so, and you could always buy that stock back again. So anyway, those are some ideas, but it's tough to really say. If we're looking at SPX, Nima, thanks for your answer. I was just trying to see why potentially something can take the market down another 10%. Anyway, you could give your thoughts about SPX potential support. Okay, potential support as we look at this. Yeah, you're welcome, Nikhil. Let me find my mouse again. Okay, so here we got, where am I? Okay, so SPX, I'll just do SPY on here. We're right at support right now. Okay, so the way that this market would get more taken down and how it would more than likely happen, obviously anything can happen, but the way it would usually work is like this. Let me draw it out for you. The scenario. Okay, so here, okay, I'm going to go to a 2-day, so it's a little bit more simple. Okay, so here's our current support. Excuse me. So if we've got this right here, this thing will pop more than likely soon, eventually. And then we'll get into probably 450. And what's going to happen is you'll probably isolate and bounce like that, and you could start rolling over. So you're going to get a few good, strong fake outs before you get further market movements. They don't go straight down. They don't go straight up. So you'll probably see a huge move up, kind of like you saw over here. And then you'll see kind of like this rolling effect. And what you're watching for is this type of action. And this is, let me make it big so you guys really get it. What's going to start happening is you'll start trending in channels on a downward cycle like this. Okay. So it's important you recognize this very quickly as it happens, because that's what's, as you start watching this, if we start going into these trend channels and we're starting to go down like this, recognize it quickly so that way you could cut here before you get way down in those bottom levels, because that could happen. Like if we really get into it, if things get really nasty, I'm talking about really, really nasty, you're looking at somewhere down here. And I'm saying really nasty, right? So if things get really bad, you'll get like this pop, it's going to go, and you got a whole bearish market for like 2 years or one to 2 years. They last usually 1 to 2 years. They're a lot shorter. Bullish markets, they last about 10 years from the history I've studied. Bearish markets, 1 to 2 years because they're faster. Okay. So bearish are faster, 1 to 2 years, they're kind of done. If you look at, and we back up and we go to like this chart monthly. Let me go here. What you can see here, this time frame, this downward time frame from the year 2000 was 2.3 years. This time frame here on the 2009 was 1.7 years. So that's why I say if we start moving on the downward scale, again, worst case scenario, we're looking at maybe, a 2-year time horizon, and you're probably looking at, pretty significant then pullback at that point. But then, you're watching some of these key levels in the past. You get pullbacks here, but recognize maybe a pattern like this. Again, I think it's too early for that type of stuff. You'll still see like probably a bounce somewhere here to about 450 soon. If you don't, then that'll get very, very serious very quickly. You're going to see some serious action, because if this breaks, eventually you get a bounce. It's either going to come here or you get a bounce up here. So depending on that, that's how you're going to dictate how nasty it's going to get. All right, you're welcome, Sonny. William, for like Microsoft and Apple, wouldn't you just play the continuation instead of actually playing the earnings? Yeah, you could play the continuation, but you could use earnings as a hedge. So what a lot of traders do, at least I know from the accounts I've seen and from the guys I've talked to and the brainstorming I've done, is like, look, if you're continuing, like depending if you're continuing down or up, doesn't matter. Let's say you're continuing on the downside and you play the continuation. Okay, so let's say we're continuing up. Most people continue on the upside. So let's actually do that first. So let's say you're looking to buy on value, but what they'll do is they will short the earnings to be able to make some money on the earnings. So let's say you've got $1,000 at risk on Microsoft, again, just for numbers sake, but you're trying to make 200 on earnings on the downside. This way, if the stock goes up, you're okay, and you maybe don't make, let's say $1,000, you only make maybe 800 because you lose 200 on the earnings. On the flip side, if it goes down, you make 200 on the earnings, but you lose 800 on the stock, right? Or 1,000 on the stock. In total, you're losing 800 then at that point. But at least doing the earnings opposite of your investment allows you to hedge that position, and that's why the earnings are often used as a hedge from an investor standpoint, or the option side is you might trade earnings where you make money on the downside on the earnings, even though you're a long-term investor, to hedge off that earnings risk. Okay, that's a way to cut the earnings problem, and vice versa. Like you could trade it. Okay, so let's say you're bearish on it, but then you do the earnings maybe like with a butterfly on the upside, just in case that stock does pop, so your short doesn't get into trouble. I hope that makes sense, William. A little more complex, but usually you're multi-layering things to make it happen. All right, Adrian, definitely a value investor. Thank you for the response. You're welcome, Adrian. Thanks so much, Sasha. I like the Iron Condor strategy. Mercy says, yeah, I like the Iron Condor. Yeah, Iron Condors are great. I like Iron Condors as well. They're a very good strategy. Most people do Iron Condors like this. I'd say 99% of the people do it like this, and it's fine. The problem right now doing an Iron Condor is if you go in, like let's say I got an Iron Condor here, and I go this way, if I get a snap up, this side will get blown out. My call side will get blown out. So you have to be careful that you hedge that upside pop risk with maybe less contracts, or just do the put side first for a little while, like 60-day plus, because you're trying to wait for the volatility to go down. So that's why you do 60 days, or 70 days, 90 days. I've done things 90, 120 days, where eventually you're looking for a pop, and then with that pop, that volatility comes down and allows you to kind of give you time for that volatility to come down. Because, you know, this is one day, could be 1 week, but in the longer 60, 90 days, the market can change very quickly in 60 days, 30 days. So you want to be careful on that call side here, right there, when it pops, when you do these kinds of things. So that's where sometimes the gamma iron condors, where you're kind of actually buying an iron condor instead of selling. But here you have a lot of negative theta that most traders don't get and understand. And that's why I usually save that for more advanced people and mentoring stuff that I deal with. Adrian asks, how important is technical analysis to individual that is currently a passive investor? I'd say not as much. But I will say on the longer term, it's nice to kind of understand it from a, hey, the price is this, where do I buy the dip? It's kind of like when I deal with currency stuff, when I do a lot of exchanges. So here with US dollars and Canadian dollars, I'll tell you right here, I saw this kind of double top and we converted some additional income and funds at this level because I'm like, it's getting a little toppy, and then it pulled back. So from a long term, because currencies move really slow, and if you're looking at a year time horizon, it's kind of near the top. You know, we didn't hit it at the top. I kind of hit it right over here. And he hit some stuff. But again, even on a value investor, like if you're adding money every month, it's not as big of a deal. Like right now, you got a bigger downturn. So you're like just kind of looking at a trend chart, and that's all you really need to look at and learn. If you're like a long-term value investor, you don't really have to look at charts too much. Just take yourself a monthly chart and just draw a trend on the bottom right here. And that's kind of an average value. So if this stock actually pulls back here, that's a really good buy spot. Right now, maybe a little too ambitious, right? And that's how you might want to look at things, is that, okay, here's my trend. Here's the actual trend. We're probably extended. So even though you may think you're buying it at value, that's about all you need to know from a passive investor chart perspective. You don't have to know that much into it. But here you've got this kind of channel right there. And if this pulls back here and bounces, that would be your buy point. And that's what you want to know from a long-term chart perspective. But again, right now, you're still way up at the highs, even though if you're a value investor. So you'd want to always be careful. Thanks a lot. Yep, you're welcome. So if I just don't want to deal but hold my money somewhere, gold, you can. I mean, look, you always sprinkle your money around all over the place. You don't put a bunch of money everywhere. You could do treasury bonds, that kind of stuff, but they don't pay as much. Again, if you don't really want to trade much or you don't want to do a lot of investing, something like SPY or QQQ, just, buying like a share a day, like one share. That I would say is the most diversified from a capital allocation standpoint, is if you get one share one day, you're up to 365 shares, right? Well, not really, because there's only 280 trading days in a year. So you're up to 280 shares. Not everybody has that kind of capital. So if you can't do that, then it's one share on Monday. Okay. If you can't do that, one share every 2 weeks. And that's how you start diversifying on price. And if you see a big down move, you could buy it. But even gold, it doesn't always do well. A lot of people always say gold. I got a buddy of mine that's always like thinking the whole market's going to tank. We got to go in a bunker and that kind of stuff. But even gold has its problems, right? So you look at here from 2012, 2017, it's not like gold was resilient to things. So it's all just about spreading your money and risk. That's how you want to look at it. It's not all tied into one. When people are panicking, it can still tank, and you're getting up there with gold too. Like look at this gold trust. This is the GLD. There's also the dust, but this is, gold miners. Sorry, that's the bear shares. But anyway, my point is just you could park your money in different spots, but it's, it's relative to what you feel comfortable with. So GLD is the more popular one. Looking at TLTs, here's the TLTs. When you look at this, the treasury bonds, but it's a matter of personal risk, like what you're thinking of. Okay, Nikhil, what are some good ways to create uncorrelated portfolios like KWEB, FXI? Worth it? I think rather than trying, like a lot of people, what they try to do is they try to correlate, and this is because they learn this from the news and from different mediums, content mediums, but they try to find like different areas like your GLD or your FXI or XLE. I got a guy that trades the Brazil, what is it, EWZ, I think. I forget. Brazil. Yeah, so he'll trade things Brazil, but look at this. Like even Brazil, they kind of correlate together, right? Remember, the market is global. So instead, you have bullish positions and bearish positions. That is, I'd say, much better than trying to find like, because what you'll do is you'll probably trade like one ticker over here, then you'll say, I want to spread things over here and I want to spread things over here, but they're all bullish. And it's like, huh? Then you're not really that diversified from a market movement. So spread out your capital where you have some non-directional trades, like, theta, iron condors, that kind of things. Spread out where you have some long investments, and long investments could be also short investments. It's just that they're for longer durations. So you've got different things that are kind of working together. You got things that are maybe speculative. You got a little bit in penny stocks if you want. Like, again, I'm not saying you have to. I don't really deal with the penny stocks, but I'm saying, like, if you like that speculative things or you like crypto, some people do, and it's fine. There's nothing wrong with it. Like, I don't think there's anything wrong with like crypto or this or this or this. I don't nag any kind of those types of investments. It's just more along the lines of spread your capital. My big phrase here and thing for you is just spread your money. And if you spread your money, different things on different days with different strategies at different points, you'll be way more diversified than trying to like find a specific thing that'll try and hedge you off better or something like that. So instead, I'd say spread your money, spread your capital. You'll be way better off. Okay. You can buy in slices too. Yeah, you can buy in slices. You could buy in like micro increment shares these days and stuff as well. Do you find yourself still making common mistakes such as revenge trading or getting emotionally involved? I don't usually do revenge trading because I find that the reason revenge trading happens is, again, people trade too big. Emotionally involved, I think that's tough to separate. Yeah, I mean, you do get emotionally involved for sure. Obviously, even today, my real portfolio took a dip. Like, you take a look at this account right here. This is just a paper account. And this one, took a dip over the last few days. And I have long investments, but you can see even this account's down 5.8 grand. But I'll tell you, my long investment account took a multiple figure downturn in the last few days. This is 4 figures. I did easily a 5-figure downturn over the last week, and that's just because I have a longer investments and that kind of thing as well. So it definitely happens, and but you have to kind of also understand that the market can change things very quickly in 30 to 60 days. So if I have like longer duration stuff, you have to look at the longer term game in some of those aspects, and that's why you have different baskets of stuff. Okay, Adam Watson writes, previously sold put verticals at 41.60 on the SPX that expired January 31st. Would you cut the loss now, or can I be hopeful that the short-term pop will make it expire out of the money in a week? So if you've got SPX at 41.60 and you sold put verticals, let's see, because what you want to look at is the probability of touching. This is the way I would approach it. Again, it depends on you, so your risk tolerance and levels. Hopefully you've got other things spread out, Adam. So let's say you've got 3 contracts and you have 1 contract on January 31st, but then you also have some contracts on, let's say, like another date. Here, let me pull it up here, SPX. And here, this screen here. So we've got some stuff, let's say January 31st, which is 7 days. Anything under 7 or 10 days, they're quick to expire. So you always want to be very careful. But if you have some stuff January 31st, February 4th, February 9th, that kind of stuff, that's better off. But the way I would approach it is look at it like this. If I've got the January 31st and I got 41.60, what you can do is, here I've got 41.60 puts. I'm looking at probability of in the money. You got calls or puts? Let's see. Previously sold put verticals at 41.60 that expired January. Would you cut the loss now, or can I be hopeful? So you're still out of the money, right? 41.60, you're at 42.97. So if you've got some verticals on 41.60, let's say 41.50, something like that. SPX is a huge product. You're at a 28 delta, and your probability of in the money is kind of 30%. So you still have like a 70% chance of success. Yeah, the market's very volatile. But you might be at a loss because you sold verticals, which means you're short Vega, which means you're probably taking a bit of a beating big time. But from a probability standpoint, you know, it looks okay for now. But yeah, 100-point move can easily whip that very quickly. What I would do is look at also, if I was trying to make, let's say, $100 on the spread, if I'm at like 140 loss, you could take it off, right? So if I'm trying to make $500, I probably don't want to lose more than $700. If I'm trying to make $2,000, I probably don't want to lose more than like $3,000. You're kind of trying to aim for something like that. That's also another good way of kind of like thinking, okay, my stop or my limit, and then you can either roll that position or so on. But it's gonna give it your trade a little bit of wiggle room, but you don't want to be too tight. But it's also on the basis of, hey, if I'm risking $100, don't lose more than like 145, because you're always risking 100, or 150 to make 100, 150 to make 100 to get the probabilities to work in your favor. And then, you know, then the probabilities work out. But if you're risking like, let's say 5,000 on one trade, 200 on another, then that $5,000 trade is probably the one that'll go against you. And then you have to make a lot more trades to have it go against you, or make up for it, for that matter. Okay, have you ever implemented any of the Nassim Taleb investment strategies? I don't know what types of investment strategies are in that case. As for my thoughts on BBIG, somebody wrote in, here's the funny part. If you go in and you go to, just pull it up for you guys, there, YouTube critical charts. My thoughts on BBIG. I actually did a video on BBIG not long ago on this critical charts channel, which I just post a lot more on now for just technical stuff. It's right there, Vinco. If you scroll down, it's right here. And I'd say that is a better evaluation than what I'd spend on it right now. So check that out. It's going to still apply today. Yeah, so those are kind of my personal thoughts. Yeah, right now, looking at the market, you're already seeing like somewhat of a snap up and then a rejection. I mean, we're whipping around. Like I protected some of those positions to some level for some whippy, choppy markets. But look, we snapped out. Like even if you look at just recently, this is what I'm talking about. But I'm looking at also the dailies for this type of action. You'll see this snap up, like we were selling off. You'll see snap ups, but then you'll see rejections. So it's the same thing, like boom, wave patterns. If you see this on the daily as well, you snap up and you can get a further pullback. That's where that market can get nasty. And that's what I would look at. And this is just on the minute chart, but that's where we look at, let's say, the daily chart. And if you get this snap up here to the 450 and you get a rejection, that's where the problems can start lying. So be very careful on that for this next week. This is where things can really start being in a little bit trouble and a lot more choppy here because you got a lot of volatility. With a lot of volatility, the spreads, the pricing is bad. And you have to wait and be patient. So you always want to trade lighter. If I had my trading a correction PowerPoint slides done, I probably would do a live class on it right now, but I don't have all that done right at this moment. I'm only halfway done with that class. I mean, I thought about pushing it a little more, but I looked at it just 10 minutes ago and I'm like, ooh, I still got too much work on that to do, because I like to have all the slides ready for you guys. That way it's just faster to do the classes and lessons. Otherwise it'd take me like 8-10 hours to cover the material instead of like 4 or 5. And I know your time is also precious. So here, as we look at some of this stuff, you could get pretty easily a bounce here in the next few days. I don't know, but easily you could get a bounce to this 450 I'd watch. That'll coincide also possibly to this level. So it's kind of that zone that you're looking for, this bounce. And that if that holds, that could be okay. But if it can't, and if you're seeing some weakness, even if you just see a little bounce and roll over, or you see a follow through or break of this level 420 or so, that's where things can get nasty. So anyway, right now, from just the longer term perspective, as we really look at it, you're still kind of in the upward. It's still actually fine, ironically, right? If you look at it from a monthly perspective, yeah, you got a nasty month, but nowhere near as nasty as these. Okay, so yeah, it's still not good, but that's also because we're stretched at the angle versus an angle of maybe like this. Like previously we had an angle like this, now we got a steeper angle. So people were making more money from their investments, and now it's just given back some of that quite a bit. So, and then we're basically back right now to July of 2021. And yeah, I can easily go back even further beyond that. If you look at stuff like Microsoft, you know, people looking at this, if you saw today's action, you're basically in around July, August of 2021. So it's about 6 months of gains gone, or price action gone, in about 1 to 2 weeks, 2 weeks or so. So be very careful. Thoughts on penny stock strategies after this market correction? I think, you know, with penny stocks, it just depends which penny stocks you're talking about. Penny stocks, most of the time, I'll say most penny stocks, they're better shorting opportunities than they are going long. The way to trade penny stocks is it's a little different. What you're doing is you get a basket of penny stocks. Let's say you were putting in $1,000. You get 10 of them and you put in $100 in each. And what you're trying to do is 10 to 20x them. It's kind of like doing butterfly spreads. You like have a butterfly for 20 cents, but you get out of it for like $1. You're trying to make 5 to 10 times your money. And the same thing here with penny stocks. I'll put $100 here, $100 here, $100 here. And one of these maybe you will turn into, let's say, $3,000. And that's maybe what you're trying to do from a penny stock strategy perspective. As for the majority of them, from an active trading perspective, a lot of them, they just go down. So most of the time after the pop, you actually want to short them. And that's why a lot of penny stocks just stay cheap and they stay lower forever, really. You know, it's very rare that you see penny stocks go into $100 or $200 with time. Okay, let's see what we got. William, the Dow is rejecting off resistance. How low do you think it will probably go? It depends, again, on duration, right? If you're looking at Dow Jones. And when you're saying rejecting off resistance, so it depends which resistance you're talking about. There's a lot of levels to kind of watch. If you look at the Dow Jones, it's only got like 30 stocks, so I don't usually watch it that much. It's not a really good indicator. Most of the big boys, they don't really watch it as much. I'm really looking at S&P, NASDAQ. I mean, right now we're kind of at this 336 level and it's holding those levels. It's fine. You got this double top here. That's a problem. So for now, we're in a sideways movement in this Dow Jones area. You've got support right here. Even if it breaks below here, which it did a little bit, this is known as confluence, as I mentioned, and it can still hold here and be okay. And you could have, I forget what year it was studied, but there was a 20-year sideways market. I think it was in the 60s. I'd have to double check that. So like 1960 or 1965. I forget. So anyway, there was like a 15 or 20 year sideways market, and you know, you could do stuff like that too. I'm not saying we will, but because the market's completely different now with robots, algorithmic, and that kind of stuff. But you know, a critical level here for support, you're right at 330. That's kind of a pretty solid base level. You also have resistance and support at 340. So you've got some of those levels here that you're also looking at, because there's a lot of volume pricing right at that 340 level. So watching those levels, we do have a bunch of selling pressure that did come in, and here as well. And those have been a little bit of a problem with these kind of double top zones here on the Dow Jones. So anyways, I hope that helps. If there's any other kind of questions, let me know. Kind of been here for about 48 minutes already, so hopefully we got a chance to answer some of your questions here. And then what we can do is, if you have other questions, you can also do something on the Discord and sign up there for requesting any videos and questions, notifications, that kind of thing. Adrian asks, is Tesla's run over? Should you short them? I don't see them exceeding that 1200 mark again. Yeah, the Tesla, you have to be really on top of the game when you trade Tesla. It's really right now, again, also in a sideways area. That 1200 is a serious area, but it's not to say it can't go higher. I don't discourage things. I always look at the other perspective. Can it go higher? Absolutely. Can it go lower? Absolutely. But right now the price action is dictating we're in a sideways trend with Tesla between this 1200 and 900 level. So if you're the person that's selling puts at, let's say 700, let's say you're doing like 60 days out or something, and you're doing put verticals, that could be like one good play, because you're in this range and already you're down here. And if it keeps selling off, you could do like, let's say the 90-day puts maybe at the 500, and eventually you're looking for that stock to pop. Just like with Microsoft, eventually you're looking for it to pop, right? Once you break through, like let's say this 1200 level, then again, you've got a next level, next range. So this trend, we've only been going November to March or so. November to February, 1, 2, 3, 4 months or so. This trend can last like 2 years or 4 years, and then it could power higher. It is the same thing. Like if you look at Amazon here, this trend actually, people always look at this big company and it was so popular for many years, and it's still a big company, obviously, but that trend sideways, that's a sideways trend in this stock. And that thing's been going on for a good year. And, it doesn't feel like it because it moves like, 80, 100 points easily on a day-to-day basis. But it's really a sideways trend. And the same thing with Tesla. It's really actually a sideways trend. We got extended, and the same thing here. Now we're probably short-term extended to the downside. We could probably snap up, but then back up here, we might be extended. So we still got this sideways action that we have to account for a little while. So that's what I would look for as far as Tesla goes. Nima says, normally selling verticals in high VIX is favorable, right? But would you say it is wise to do that in the very high VIX right now? Yeah, you could. You could do that. But what you would do normally is you'd probably go in and sell premium with protection, right? So it doesn't matter what you do. It's just what you would do is you do it with kind of protection. So like, let's say I go in and I'm doing, let's say I do this on this paper platform. I've done it before with you guys. Like, let's say you're looking to get a stock or something on the SPY. I think 2 years time is correction. Let's say you're going like 80 days out. What you would do is you'd get some stuff with protection, right? Either trade less shares or contracts. But let's say I'm going into maybe like this 410 on the SPY, and instead of blast all, I'm going to go in and just do single order. 410, I'm selling, and then let's say a 407, and I will analyze this trade. And I got a ton of positions on here on this one, so let's just hide the positions, bump this to a bunch of contracts. So now, look, a lot of people will say, hey, it's time to sell premium. Yeah, but what if the market keeps going down? So, what you would do is normally buy like an extra put. So instead of like 8 to 8, you would probably go something like 8 to, well, in this case, maybe not as much. I'd have to go, let's say, maybe just to show you an example, maybe I need to go to 20 to do the difference. So I go like 19 to 20. Yeah, I mean, even then, that's not, hold on. I'll give you a good example. Here, spread it out wider for you. So this is still a lot better than just doing the vertical, because now, and remember what we said, the call side, meaning if you're bullish, it actually is less favorable right now. But this way, when it tanks, like the losses are a lot less than they would be if you're just getting the vertical on its own. So you're buying like an extra put in this case. And if you can't afford that, like let's say you don't want to do 20 shares or contracts and you're not doing 20, 20, 20, what you would do is just do a vertical defined spread, or you're trying to go in and you go longer duration. Like let's say you allocate like one contract and you tighten up also your strikes. So here I do one contract, but instead of 410 and a 405, I do like a 405, 406, like something super cheap, something super like, hey, just be cheap about it. It's okay. That's the market. You're trying to just nibble things. And I'm just trying to put in like a tiny amount of delta. Like my delta amount is like less than even 1, but I don't want like too much theta or vega. It's fine. You should have some theta here, but I'm doing longer duration. I'm not going to get that much theta. but I'm just trying to watch out for a possible bounce. And if you're trying to look for that, selling some premium, you could do this and you start going longer duration for a possible volatility collapse later on. And this still gives you a large, 10, 20 points on the SPY. And then you do another contract maybe at the 380 over here. So then what you can do is go, let's say, even further duration. Let's say we go to July, and the 406, 405 is not traded. So let's go 405 and 400, and I'll do July on this one as well. There we go. And you can see here, I'll be able to even spread it out even further. Okay, so let's go 400, 395, right there. So something like that would be kind of like a better spread, if you know what I mean. So hopefully that makes a little bit of sense for you guys from a trading perspective and so on. Just kind of let me know if you have any other questions. We're going to probably wrap this up here very soon, and just see if I got any other final tidbits here. Then we'll kind of go from there. Okay, so I'll wait another minute if you got any other questions. Otherwise, I'm going to call it a day and kind of sign off, because I got, let's see. All right, so I think we're good. And then what we'll do is, yeah, you're welcome, Rob. Welcome. I'm going to sign off here, and then enjoy the rest of the week ahead. Be careful trading in this kind of market. It's very volatile. The bid-ask spreads are very wide. Definitely don't do market orders. Make sure they're limit orders, and make sure they, you're watching out carefully as those orders fill. Sometimes you have to just let them sit for like a good hour, 30 minutes to get a good price, because you don't want to get whipped around with your pricing. So be careful. All right, good luck, and stay nimble, and I'll catch you guys later on, okay?